And we're off and we're recording. Welcome to our call tonight, Alvin Girl, October the 22nd, 2020. Thank you for being on the call tonight. Again, we are in our mission to help 1 million families become millionaires by the year of 2030. I believe everybody on this call tonight ought to claim that you are one of those millionaires. Start speaking that into your life. Start hearing yourself say it. Tell anybody, tell yourself, tell your church. If you're afraid to say it at first because you don't know how to say it, then just kind of whisper to yourself real low. I knew a lady one time, she could not say $1 million or the number 1 million. If I wrote this number out like we have it now, 1 million, she'd call it $10,000, anything. She just would not call it 1 million. It's something about her brain was just, I said, look, let me show you how to do it. You comment it off in threes. This is the 10, this is the 100, this is the 1,000, this is the million. Well, she just couldn't get that. So I want everybody to know you can be that. If God brought you here, he brought you here because he given this company 1 million millionaires. And surely he brought you here because he wanted you to be one. So tonight, as we get started on our training, I have a very special guest we're going to be bringing on in just a minute. But let me show you some keystones of what we're going to do tonight. Now, what we have here, ladies and gentlemen, is we have a W-4. The W-4 that we have, and we're going to be using over the next, I don't know, 5 or 6 weeks, whatever it takes us to get through this, because we are going to have to talk about our new memberships and things like that. But between now and the end of the year, we're going to take this W-4, this employee here. They have a couple that make $65,000 and $42,000 each. One makes $65,000, the other makes $42,000. It doesn't matter who it is, male or female. The system does not care about that. Okay. Now, but that's $107,000. We have lots of families in this position here now that I've talked to lots of single people that make $100,000 themselves in my econ, and they have no children at home, and they are there just kind of doing the best they can, and they said, why am I struggling, Alvin? I make good money, and I'm struggling. So here's a couple that makes $65,000, one does, the other makes $42,000, that have no children at home now, in their early 50s. Now they have worked hard, got some things going on in their life, but look what happened now that all the children are gone. This is the result of the W-4. I'm not going to go through a W-4 training tonight. We teach on that all the time. This W-4 says out of their check, they're going to withhold $13,642. The taxes they're going to owe is $9,670. They're going to get a refund of $39.72. Now, here's what most people do. Most of you out there is familiar with, we need to come down here and change this W-4. So if we come down here and change this W-4, we bring this thing back here, and let's bring it on back to around $2,000. Now, what we will do is now when we do that, it says that the person making $65,000 will have $23 taken out of their check, and the person that's making 42 would have $9 taken out. That's $160 less in this case, and that's $333 here. So you're talking about $493 difference coming back in their household. Almost every one of you who've been with us any time is used to us talking about the W-4, making that change, putting that money back in your pocket. Most of you refer to that as step one. Correct the W-4, put the money back in your pocket. Now, most of you are not familiar with step two. Step two says minimize taxes through our cash flow manager. So step two, when they say minimize taxes, that means we need to minimize this $9,000 of taxes you're paying here. See, because, okay, I understand they're paying $9,000 on the federal, but they're going to pay some on state, and then they got Social Security and Medicare. So this couple going to end up paying close to $20,000 unless something happens. So yes, they make $107. Well, since they got their bills based on $107,000, 20,000 short is a lot. So we're going to show you through the course of these next few weeks how to minimize taxes. This is the tax that they owe. See, yes, when we take the W-4, just what I showed you, we can correct this and get this refund. The refund is an overpayment. They didn't owe this amount, but they owe the $9,670. And how did President Trump get $750? Well, I don't know everything because I ain't seen his taxes. I don't know whether he did anything illegal or not, but doesn't necessarily say he did something illegal because he only paid $750 in taxes. He had some deduction. I don't know where they come from. But what we're going to do over the course of the next few weeks, between now and sometime early December, we're going to be showing you training on how to lower this $9,600. And every time you lower it, which is minimizing, it's going to come back in the form of a refund. Whether it come back in the form of a refund, you can change your W-4 and have it come back in your check every week. We're going to show you how to do this. Now, the most important thing I want to say here tonight on this, and then I'm going to turn this over to my very good friend, Satina here, is, ladies and gentlemen, we're in the midst of a coronavirus, and we have been sheltered in place. Those of us that, could, some of you had to go to work and do different things. I understand that because of your position. But for many, many people, sheltering in place has been the order of day. And for those of us that are independent contractors, we haven't been able to get out in the street and prospect because folks wearing masks, you got to stay 6 feet apart, can't do it. You haven't been able to do a lot of that stuff. So some of the things that you were getting, like a lot of miles, you're not going to be able to get them this year. Some of the things that we were getting, like travel and some of those things, going to meetings, we're not going to be able to get that this year. But Buddy, Tatina, and I have come together and collaborated. That's the beauty of working with her as a tax professional. Now, I know none of my other tax professionals get mad, but she's just kind of right here with me. And, me and her can get together, and we social distance, but, she can come by the office, I can go by her office. We're a couple of miles apart, and so we can work together. The rest of our tax professionals, don't be mad, okay? But here's what we're going to do. We're going to show you some things that you can do in this pandemic. For this year, you need to know these things before January we get here so you can make decisions and make corrective actions between now and January, the tax time when you get your W-2 and start filing your taxes. So we're going to show you these things. So tonight we're going to start off with showing you decisions that can save you portions of this $9,000. By the time we get through it all, the goal is, and I don't know whether we'll get it all done or not. We haven't worked it out in advance. We're going to work it out week by week because we know what to do. So we're going to try to see how much of this $9,670 we can work down. So I want you to remember, this is going to be where we started at. And when we get to the end, we're going to come back and visit. Because remember, the idea is to get as much of this money back as you can, then income shift. We're going to show you how to income shift at the end. So without any further ado, I'm going to relinquish the floor, and I'm going to turn you over to my very good friend and our good buddy here, Miss Tina Poingay, out of Learburn, Georgia. She is Micon Infinity, and she does taxes as a professional for the last 30 years. But she and I oftentimes talk, as well as she loves the tax business, she knows Micon is her retirement package because of the leverage and residual income. So, Mr. Tina, I see your lovely face here, and it is now in your hands. Take it away. I'm going to mute you. You got it.
All right, Mr. Carey. All right. Good evening.
We hear you. I'm through.
You can hear me?
I hear you and see your screen. I'm through.
All right. Very good. Well, good evening, family, and welcome to this call. I am just so excited. And yes, Strose, I'm just as hyped about taxes at night as I am during the day. So this thing is really, really good to me. I just want to say, Mr. Curry, I remember some 15 years ago when I was doing taxes, and I came over to the office. I remember using space in your office to teach the tax class and to teach my tax students. I also remember opening up offices, tax offices with other associates in other states. And so my claim to fame, while there might be other tax professionals in my econ and around my econ, I always tell people that prior to my econ, I just did taxes. I was a tax preparer. You know, I had a lot of energy, and I was just really on the ball, or so I thought. You know, graduating from Georgetown was supposed to have given me a class education that was supposed to allow me to go out and start a business and just make all this money. I did not learn to be a tax professional and handle myself in that manner until I latched on to my econ and the training and just began to live, breathe, and sleep, helping people keep their money. So I take a little issue with that. You know, I am my econ, my company is dedicated to growing to help other people see the benefits of my econ. All of my clients, when they come through, they get a my econ presentation. So I just want everyone to know that I take this very seriously, and I'm very excited every time I get an opportunity from a tax perspective to talk about the tax advantages of some of the things that my econ promotes and teaches. So with that being said, tonight we're going to just look at the tax advantages of contributions made to retirement accounts. And, you know, people really miss this. You know, there are not a lot of people who just understand coming into the tax appointment how significant making contributions to the retirement account is. They really don't understand the tax advantages. You know, people go to the HR department and they'll tell them, yeah, well, you know, you can sign up for this and, you know, get a 401k. And people really don't understand. But I know for sure they don't understand the tax advantages because I run into them all the time. So that's what we're going to talk about tonight, because at the end of this series, our hope is that you can see how maxing this account out or, you know, putting more money in it. And, you know, like he said, our tax clients in this example are, you know, in their 50s, okay? And so William, in this example, is a construction foreman. He made $65,000. His wife, Mary, made $42,000. You know, and so there are advantages to making big incomes, of course. But what we need to teach people how to do is to maximize the advantage that that income affords them on their taxes. And one of the biggest ways is through a 401k or contributions to 401k, 403b, and plans like that. So in this example, like Mr. Curry just showed you, our taxpayers had expected tax withholding of $13,000. Now, actually, I put this whole W-2. Yes.
So, Tina, is there any way to make your screen larger? Is there any way to make that?
Yes.
It's showing it really small on mine. Keep coming. Keep coming. Can you go a little bit larger? All right, one more time. There we go. I can see it now. All right, you may have to scroll up and down, but I can see it. Okay, good. Thank you.
All right, okay. All right, now you're going to throw me off. You know I'm technology challenged. But okay, so just let me know if you can't see it, all right? So our objective is to, see, there we go. Hold on, Mr. Curry. Okay. All right, so our objective is to make sure our tax clients get all of the $13,000 back that they had withheld. That's where we're going to go towards the end, but we're going to start at the beginning and help them, you know, get some money back right now. Okay? So the refund was 72. And so now what we want to show them how to do is how to reduce the tax bill by putting money into a retirement account. And so basically doing that is these are the ways that I'm going to suggest that we do it. I mean, this is not my suggestion. This is just the way it's done, okay? People need to increase the 401k withholdings. You know, if you have a job and you have money that you are contributing, that is a powerful tool to help you get more money in for your retirement. And then we have a thing called catch-up contributions. The catch-up contribution is one that a person can increase the amount of their contribution based on their age, so they can, either max it out, or then after they max it out, then they can add additional monies to the contribution based on their age. I believe it's like if you're 49 or younger, you can do, let's see, I think it is 5,000. And then when you hit, hold on, guys. Okay, so if you're age 50 or older, the catch-up provision gives you a contribution of $6,500. That's for 2020. The regular contribution limit is $19,500 for tax year 2020. All right, so what we want people to do is to go ahead and, put that money in that 401k. Then we want them to make the catch-up contributions, and then they can also contribute to an IRA. Now, when they contribute to the IRA, they can do that as well as contribute to a 401k. Now, I am not the expert on how to set all of these up. We'll let Strose teach you all that. I'm going to show you what it does to a tax return and the benefit of it. So a person can also open an IRA for their spouse. And then with that money, they can save that tax refund and for their retirement. And we all know, just based on my econs teaching, how interest compounds, and we'll talk about that and show everyone how all of these savings are going to put more money in their retirement. The objective is to create millionaires, and that can be done right here in this example with our tax clients. Now, remember, if they're 50 years old and we're looking at the average retirement age of 65, they have about 15 years, and this can get done in 15 years. So let me show you. Now, our taxpayers, remember now, they earned $107,000. Mr. Smith bought in 65, Miss Smith bought in 42. That's 107. This is what it looks like on the tax return. That's $107,000 in income. And then here is the $9,800 that they owe in taxes. They had $13,000 withheld, and this is right in line with the W-4 that Mr. Curry did initially. And so the refund, is estimated on the W-4 to be about $3,900, but in actuality, when you put it on the tax return, it was $3,700. So this was prior to them making a contribution. Let me go back up. Okay, 107, that is their wages before a contribution. All right, now, so the tax liability with no retirement contribution, and I want you all to, take notes, so if you have questions at the end, you can ask them. So the wages were 107, the taxes were $9,895, the refund was $3,745. Now, that's the federal. And I went so far as to show you what is going to be also on the state, because I am a tax professional and I have tax software. So I threw it in there. And so they overpaid the state $190. Let's look at that. Now, so here's what I want people to, sort of understand. This is what all of those transactions will look like on their W-2. All right. So here's the 53. So the 107, remember, was $65,000 plus the $42,000. So what Alvin and I decided was that they made about a $18,000 401k contribution. So what happens is that 18,000, 12 came from Mr. Williams, went into Mr. Williams' 401k. That's what this 53 is. So the difference between 65 and 53. Now remember, box 1 is what's taxable. Here is the contribution. I just want you to understand what it looks like on your W-2. Because a lot of people come to me and they bring these W-2s and they really have no clue what these boxes mean, what these letters mean, or anything. So I want you to understand when I show it to you on a tax form where it's coming from. Now look at Mary. Her 36, so her contribution was actually 6,000. His is 12, hers is 6. That's how we come up with the 18. But look here, the Social Security, Medicare wages do not change. So this savings is on the 401 contribution, and it comes right off of the wages that they earned. All right, same thing with the state wages. Again, it is based on the 53. All right, so that's where the 89 comes from. Okay, make sure you understand that 53 and 36 is the 89. So now our taxpayers are only being taxed on wages of 89. They still earned 107, but because they made contributions to their 401k, they're only being taxed on 89. Here is a beautiful thing. Let's look at this, what happens. All right, so they still have, hold on, y'all, I'm sorry, I'm technology challenged. Let me get to the bottom page. Okay. So right here, the tax on that is $7,300. Remember, it was $9,000 before it went down. The tax went down. Because we have not dealt with showing them how to income shift, they still have the $13,000 being withheld. We haven't touched that yet. That's going to be, in a future class. Right now, we're just dealing with making contributions to the 401k, 403b. All right, so what did it do? It increased the refund. All they had to do here, folks, was make a decision to start investing in themselves. They made a decision to start investing in themselves. Now, one of the things that's really crucial is that, whenever you are working and you're receiving W-2 income, you want to sit down with the people in the Human Resource Office and make sure you understand, what contributions, what deals they have going on. Does your job participate or match? Do they give you a percentage in matching the money that you contribute? Do they match it? You need to ask these questions. And a lot of times, just like we never really asked people or understood how to fill out that W-2, that W-4 correctly, we missed the boat on getting information about that 401k contribution and, our retirement plan. So that is something that's very important. You want to learn and ask questions. You want to make sure you understand, what does my job offer? Do they match anything? And then let's understand that is free money. If they match something, that's free money, folks. And so right here you see that your refund went up. Let's look at the next slide. So a tax liability with contributions, right here, that's at $89,000. And if you look at the refund, it's $62.73 on the federal, and that state refund went up to $12.25. All right. Hold on. Okay, that's that. All right, here's what I wanted to get to. So right here, without any contributions, the federal refund was $37.45. With the contribution, it was $62.73, which created a tax savings of $2,528 on the federal. Then on the state, the tax savings was $1,035. This is because they made a conscious decision to invest in themselves. Now, they have tax savings here, and we haven't even started talking about those common tax deductions, right? We're just dealing with the retirement contributions that everyone who has a job, and whose companies participate can create opportunities to save tax dollars. All right? The other thing that I want to introduce to you tonight is you can also make a contribution to an individual retirement account outside of and above and beyond that 401k. And in this example, we had them, make the maximum contribution. And so for the husband and the wife, that was a total of $12,000, $55 for her and $65 for him. And I said $55 for her because she is not yet 50 and he is, and so he gets $65 and she gets $55. But what did it do? Again, now we're not even talking tonight about itemized deductions. Everybody understands that right now, because of the Tax Cut and Jobs Act, at least most of my clients are not able to itemize. So this couple took the standard deduction, which is $24,400 for a couple filing jointly. So anyway, we get back to what did it do? What did that $12,000 do? One more thing. Let me go back. This $12,000, which was a contribution, dollar for dollar reduced the taxable income. So here's the total income, right? $89,000. This $12,000 is subtracted from it. This money went into a savings account for you, and you also get to write it off or take a deduction for it on your taxes. That is, look, this is huge. If you had $12,000 that you could pull from your earnings and have it dollar for dollar reduce your total income, that means you're not being taxed on it now, you're deferring it, but you get to take a deduction, plus you get to save the money and have that money grow with interest over time. That is a big, huge mistake if we're not doing this. And do understand this. In each tax year, you have until the tax filing deadline to make this decision. So, you can already know what your refund is going to be and make that decision, right? Okay, I'm saying these are things that people just do not think about because we really have not taken the time to study and understand our own finances, our own money. We've got to be better stewards, folks. We have got to be better stewards. That's why my econ teaches us to harness, learn, and grow our own economy. You have to be the steward and the head of this ship. So right here, the tax now is $5,900. Same withholding. We didn't change that yet. That's for the next class. But look what it did to the refund. You are getting more of your money back, making decisions that reduce your taxable income, that saves you tax dollars, and also helps you grow your investments. This is exciting. I'm excited about that. This is exciting. Let's look at it. Come on down a little bit because I need for everybody to see this slide. Hold on. There you go. Come on down just a tad bit. Okay. So what happened? The contribution was not made initially, and they got a refund of $37.45 from the federal and $190 from the state. Now, some people might be happy that they got a refund, right? I don't want you to be happy with a refund. I prefer you to owe a little bit because that meant that you got the use of your own money during the year. And then if you owe them, give them what you owe them and keep it moving. But you had the use of your money during the year. So if something came up, if you had one of those things that Mr. Curry called a uh-oh, then you could take care of it because you understood your money. That's another class. But then you made contributions to your 401k. So the refunds were increased. Here are the differences. But then what happened to those contributions that you made to an IRA? The refund increased even more. It went up to $3,900 on the federal and then $1,700 on the state. Folks, that's more than $5,500 in tax savings just because you made a conscious decision to income shift this money back into your pocket utilizing IRA contributions. These are things that the IRS, the government, has set up. You know, when we talk about loopholes and things like that, these are the kinds of things that we're talking about, things that are in plain sight that we just did not know to do. We just did not know it was possible, and especially if you have an employer that will also contribute or give you any portion of it. Whatever percentage they're giving up, you need to want it and get it. All right. So in this presentation, the thing that I'm trying to get everybody to understand is retirement savings contributions can save you thousands of dollars in taxes. And just think about this. You know, if you had this money and you were doing this, let's say our couples in their 50s, if you all have millennials in your family, talk to them, because this is golden. How many of us would have made different investment decisions, or not even investment, purchase decisions? Did we really need that car? Did we really need those clothes? Did we really need to get our hair done once a week, nails done once a week? Could that money have been better used and you know, directed in another place? And we'll talk about, and you all really are going to see the impact. You all already know. I'm talking to my econ associates. You all understand how interest compounds and all of that. You know, Strose has done a lot of training on investments, and we're going to show you, you know, in the near future what that means. But we want you tonight to understand that you need to look at your retirement, understand it, put this stuff in the cash flow strategist so that you understand exactly what you're playing for. You have to have a map. You have to have a plan. And this is one that is readily available to you, and you don't have to ask anybody's permission to do this. That's the beautiful thing about this. You don't have to ask anyone's permission. And then the scripture that I use to back all of this up is Matthew 25:14-30. See, that's the parable in the Bible where certain servants had talents that God had given them. And then so the ones who took the talents that God gave them and went ahead and invested it or took it out into the marketplace, into the world, and doubled it, the Lord was very pleased. So, you know, we're asking God to have that same kind of favor on our retirements, you know, but you have to do your part. You have to take it, and you have to not bury it in some foolishness, but put it in your own economy and ask God to let that thing double, to bless it. You know, it takes time. But those are things that we can do that we didn't have to ask anybody permission for. Do not go to work and have a job where your employer is giving you a match and then you not use it, you know, because that just doesn't make any sense. And I'm saying that does not go with Matthew 25:14-30. You have to take advantage of the opportunities that we have when they're given. And that's one right there that is very, very important for you to recognize. Now, in addition to retirement savings, you know, my econ is the Personal Financial Success Company, and we teach and train people on common business deductions for home-based business owners. And so, you know, in addition to the retirement savings, and we're going to talk about the common tax deductions, but tonight we're only going to talk about two of them. One of them is, you know, one Mr. Curry just alluded to, and that's that mileage. And I know this is one I'm telling you, when people come to my office, and I'm not singling out my econ associates, but I'm just going to say when business people come to my office, they have recognized that one of the largest deductions that they have access to is that mileage, that standard mileage deduction. Well, you know, they'll come in there telling me that they have driven 20, 30,000 miles. Now, I know Mr. Curry and Ivy and some other folks can actually drive those type of miles. But The average person is not getting that. Now, there are things that you can do to increase the mileage, like once you understand how to utilize the business use of the home, and how your home office is set up, and then every time you leave home, which is your primary place of business, and you leave to go out and prospect, those miles and things become deductible. But most of us do not practice that. And if we are, we're not putting it in the cash flow manager, and we can't prove it if, we get audited. So my econ has given us the tools and the knowledge, so don't just take the knowledge, I can write out these miles, without utilizing the tools, so that if you get audited, you can prove it. But no one can come in my office and tell me that they drove promoting my econ for 20, 30,000 miles and nobody joined. You ain't made no income. I mean, you couldn't hit $600. Then I don't think those miles are accurate, and you're going to go to the IRS by yourself to prove it. So here we go. The common tax deductions, this came right out of the back office. You all are familiar with it. I want to just talk a little bit about the car and truck deduction, because we are home because of this pandemic, and we're not getting, Mr. Curry's not getting 30,000 plus miles. I'm not getting the 10, 15 that I claim, because we're not leaving home. We're not leaving home, and so what are we going to do? I want you to understand this car and truck deduction, because you actually have a choice. The IRS, this is in publication 463, but you actually have a choice. When you do your car and truck expenses, you can either do actual expenses or the standard mileage rate. Now, just something that I don't expect you all to know, I'm going to tell you from a tax perspective what the rule is. The rule is you must start out with the standard mileage rate if, in fact, you want to use it in the future. So if you start out with the actual expenses, you'll have to do actual expenses, the duration of the use of that car in business. But if you start out with the standard mileage rate, you'll be able to, decide each year independently which deduction is the greatest, and then use that method to report your car and truck expenses. Now, when we talk about actual expenses, we're talking about things like the lease payment, the insurance, gas, oil changes, all of those repairs and things on the car, depreciation, new tires, title, all of these things are actual expenses to operate a car. Now, in this example, I assumed $8,000 in actual expenses. Now, some of you may not have a car note, and so it may not be this high, but then again, I'm just giving you the calculation so that you can make a wise decision or an informed decision about which method is going to work for you at this time. So in this example, we have $8,000 in actual expenses to maintain the car. And so we're saying we use our car 80% of the time for business. Now, if you have a home office and every time you leave home, you're out there prospecting, you're trying to get clients, you're talking to everybody, passing out cards, brochures, just being, just overflow with information everywhere you go, talking to the people at the grocery store, at the fish market, wherever you go. So 80% of the time when you use your car, you're using it for business. All right? Okay, this is not right. Okay, so 80% usage, don't worry about this 50%. But 80% of $8,000 is $6,400. That is the amount of the actual expenses that can be taken if you use the actual expense method. So forget this 50%. I should have taken that out. I didn't see it. It's late. So 80% of the time you use your car is used for business, then you can take 80% of that $8,000 is $6,400 as a deduction. Now, remember, I always start people off with the standard mileage rate, because when they are getting miles, a lot of times because of the amount of the deduction, what's allowed, 57 cents, it was 58 this year, but 57 for 2020, 57 and a half. You see right here how many miles a person can drive or would have to drive to beat this standard mileage rate. This actual expenses method. But see, for me, most of the clients that I talk to have already had their cars paid for, or they're driving, some of them have new cars, but most of them have cars that have already been paid for. And so this actual expense might not be as high. This $8,000 might not be as high. But in this example, it is $8,000. 6,400 is the deduction. Over here, you would have to get between 11 and 12,000 miles at 57 cents to match this actual expense deduction. So I just put this here to illustrate for you, the type of miles you'd have to get. And so you have the option. IRS is giving you the privilege of looking at both of these methods side by side, and you and which one works best for you. And then that's the one you choose. You just need to know what the break-even point is so that, when you go to turn your taxes in, you have all of this information already in your cash flow manager. And please, please, please utilize the cash flow manager. We're going to be filing taxes again here in the next about 4 months. And you have plenty of time between now and the end of the year to sit down and capture your receipts, while you're looking at debates and things like that on TV. Start putting some of that stuff in the cash flow manager so you can hand us clear, concise records that are audit proof. My econ provides us with the tools that we need to be successful. You get the information and you get the tools to use to present it intelligently before people. So right here, 12,000 miles. Now, the other deduction that I want to talk about just quickly is the interest on the car payments. So, interest is one of those deductions, especially with the car and truck, or with the car and truck. Interest is one of those deductions that you can take regardless of the method that you choose. So the interest on the car. Now, again, you have to know what the miles are that you drive for business over the total miles of the car. That's how we get to this 80% usage. We know we drove X amount of miles, and then X amount of miles of those were business. And then that calculation gets you the percentage. Well, on the interest payment, you get to add up all the interest that you paid for your car, and then whatever that business usage percentage is, that's what you multiply times the total interest payments. And from there, regardless if it's actual or standard mileage rate, you get to claim it. A lot of people miss this. When I start asking people, well, are you paying a car note? Yeah. Well, what's the interest rate? And then I do an amortization schedule so I can tell them each year how much interest they pay. And then we look at the mileage. And then I know what percentage of this deduction of this payment that they are entitled to. So don't miss the interest on the car payment if you have a car and you're paying a note. Now, a lot of people, before I started driving, nicer cars, this maintenance expense over here on these hoopties was sometimes more than the car note. So you get to count whatever the expenses are. So if you're making a lot of repairs to a car, those are legitimate, deductions. So don't discount them, add them in, and you'll have the opportunity, to take the best deduction for you based on what you've actually done. So I just want to conclude with we are in the best place at the right time. And I know things look dark and bleak, but I choose to look at the sunshine. I choose to find pleasure in the day. There are so many negative things going on, brothers and sisters, and we can look at them, but we have to remember whose we are and whom we serve. I do not think he brought us this far to fail. I don't think he brought my econ this far, with brothers who are standing boldly in front of anybody and telling us what their intentions are. I don't think he allows them to say those things if he is not going to give them and us the willpower to see those things through. So move all that negativity out the way You know, I know we're going through some trying times, like that brother said at the start of this call. You know, pray us out of it. You know, pray us out of it. Let's keep focused and get this thing done. So, Mr. Curry, that is it. You know, if anyone has some questions about, you know, the taxes or where it shows up on the tax return.
Let's take taxes in a minute, okay? Let's take questions in a minute. I want to turn the record off first, okay?
Okay. All right.
Wow. Satina.
Yes, sir.
You on it tonight? You was on it. What a great job. All right. I do want to put this on the record, and then we're going to turn the record off and take questions. I just want to summarize this really quick. Again, remember what I said was we were trying to find a way to get back that $9,000 they were paying in. She said, get the whole 13 back. Well, remember they had already got 3 back and they were paying in 9 plus. So we're getting all of the money back we paid in. That's the same thing. Now, we said we're going to find ways. So she talked about what you can do right now in the pandemic. You can, what you can do right now in the pandemic is you can do a 401k. You can do that. Right now in the pandemic, you still have time for this year, 2020, to do your IRA. You got all the way up to April 15th of next year to get the money to put in there. But you can do a 401k and an IRA this year. You can do that. So it's very, very important that you look at how to get that done with your job or with your business or whatever. They have them at work. Just you got to try to figure this out, guys and ladies, how to get as much in there as you possibly can. Now, again, on our example, we use $12,000 for one and $6,000 for the other. You may or may not have that much just right now this year, but do your best to get some in there. We're going to show you where this money is going to end up at later on. Okay, the other thing is, from what I look at, with my travel so far this year, my use of my car, I believe it's going to be better for me to use actual expense than business miles this year. Again, we're talking about what can you do in the pandemic. So you got a car note, if you have one, in the pandemic, whether you got miles or not, you have a car note, write the interest off. You have expenses on that car, whether you drive it or not, write the car off. Look at actual versus mileage, because mileage is going to be low this year, Dexter. You ain't all over Texas and everywhere this year. So we got to think, what are we going to do? So, ladies and gentlemen, what a great job, Satina. I want to say we just started. Now, we're going to combine all of this, and we're going to come out with a Schedule C, showing you how we get these deductions, what we do with them. We're going to have 2 or 3 more deductions. The next time she come on, we're going to record this as we did tonight, and we're going to post this at A. Curry Training. So you're going to need to be with us on Thursday night all the way now through the end of the year, because we're going to be working on this and posting this all the way out through the end of the year. Of course, with the new memberships and everything coming on, we are going to have to take time to talk about those and get those done. So, ladies and gentlemen, I want to thank you for being on the call tonight. I want to thank you for all of your time here. Let me see here how to turn this recorder off, and then we can get the questions and answers here. Let me see, where is the start recording? Yep, we'll start recording. And